Good morning, ladies and gentlemen. We start this week's review with something that is actually exciting. The 5-year note, as we see here in yield, has broken out of its pennant and going north. If we increase the size of this, we will see that the break is quite definite. It tried for a couple of days to retest that line. It might do so again, but we think now the trend is definitely higher. A good 70% of our risk is now in short of the futures via options, and we think that we will reach this level here, which is 299, in the next week or so. 299 is a very important level, and let me just actually show you the last times we were here, because the last time we were here was all the way back in 2008. This is that line 299, and the last time that we can see that we were going to test it from the downside is actually in early 2008. And then we have another very important line at 373, which is a long way away, but I just want to show you that if it goes through 299, it almost always goes up to 373. There is not a lot in between. That is why we're so excited. And going back to the present day, here is the line at 303, at 299. We are quite convinced that we test it in the next week or so, and after that, if we go above that line, there is nothing between that line and 373. The bond market trades actually in it's not a great respecter of this kind of trend line. It's a much better respecter of level trend lines, i.e. yield levels where it should trade. This is telling us that something very exciting is going on in the bond market, and that we need to have big option positions at the moment. This is the 10-year. It's doing much the same, but to a lesser extent than the 5-year, and this is not surprising because the 5-year, the belly of the curve, is the one that always responds the most and the one that you should concentrate on. In terms of 10 years, we have now a move here at 303 and then at 311, which was the previous high. We think that the 10-year and the 30-year stay relatively anchored compared to the 5-year. On the other hand, the spread is so compressed that they will definitely go higher in terms of yield. They've also broken this pennant quite decisively, and it's time to have positions on in the bonds, especially in US bonds, looking for decisively higher yields. If we look at the spread between the 10-year in the States and the 10-year in Germany, we see that we are still within this consolidation range, 258 being the top. We are now going to go and test that level. It's going to be very interesting. So 10-year is definitely the 10-year in the States is definitely favored in terms of higher yields, being short of futures, than Germany. But Germany is also quite interesting. We are now breaking up on the weeklies, and we will definitely trade 55 to 57 basis points. So bunds are confirming by closing above the middle of the Bollinger Bands on the weeklies. We have basically the all clear from Germany as well to be short of the 5-year and the 10-year in the United States. If we look at the 5-year in Germany, same picture. We've broken through the middle of the Bollinger Bands. Now we should go and trade somewhere around minus 7 basis points. That is our next stop. That's a 10 basis point move, and we're looking for much the same in the States. Therefore, for certain, we have a signal for higher rates worldwide. What do higher rates worldwide imply? Well, they imply risk on, and they imply be in equities rather than in bonds. Our model indicator is at very high levels. It's now trading at 87, which is basic. This, as I've told you before, measures all the spreads and all the risk on and risk off spreads. It is saying stick with equities, get out of bonds, and it's been right for weeks now, and it continues to be right. This is very sensitive to spread movements, and therefore as soon as that is no longer the case, this indicator will fall back towards zero very quickly and warn you that you should be getting out of equities. At the moment, it's saying very much stick with equities, avoid fixed income. And in equities, something happened last week which nobody's talking about. Something that we've been long off for a very, very long time is beginning to motor to the upside, and that is Nikkei. Here we are breaking, and we broke on a weekly level, something which, a level which was very, very important, the 23,000 level that has contained us really since the drop in early 2018. We spent more than a quarter consolidating between 22,000 and 23,000, and on a weeklies we are breaking. We could have retests back down to 22,500 or something like that, but it's definitely time to be buying call spreads in the Nikkei, looking for new highs, certainly well above 24,000, probably closer to 25,000 in this next wave. It could be a 5 to 7% move without doubt in the Nikkei, and that is also giving you an all clear to be overweight equities and underweight fixed income. What does that all mean for the States? Well, we are falling slowly out of love with the States. Not that it's doing anything wrong, but we just think it's not going to be that exciting in the next few weeks. Very much the same applies as last week. 28.95 is your pivot level on the weeklies. We could trade up to 28.25, 28.30, where the weekly Bollinger Bands are, but that is only 1% away from where the market closed. On the downside, 28.70 now becomes very, very important. If we go below there, we will go all the way to this red trend line, which is now at well, it'll be next week somewhere around 2800. So the weekly distribution will take place very much if we break the 2870 level, but there are no signs of it at the moment, and we could easily go up towards this level of 2825, 2830 sometime next week. It is also volatility expiry on Wednesday, and now I'll show you a trade that we've put on to take advantage of volatility expiry on Wednesday. Our favorite trade to express our views at the moment is to be short of VX U18, which is the September contract in volatility, which is trading roughly 90 basis points rich still to where it will close out against, which is the VIX. So we're trading here at 13 in the VX U18, and it expires on Wednesday morning as the market opens. So we have best part of 90 to 100 basis points of convergence to come in 2 days. And against it, we are actually selling the S&Ps, ES. So we are looking for a move in VX U18 down towards 12, while ES actually stays very much uh, within uh, within this current trading range. It is unlikely that VX over the course of the next 2 days will trade much higher than 29.20, and in which case we will make something like a good 10 points worth of volatility uh, against the spread. So because you have 100 points of convergence if nothing happens, and you have that takes care of about 20 points of upside in ES. So only if ES were to go up more than 20 points would you even be at break even. And we quite like that risk. We think that ES is going to struggle to go higher than 29.20 or exceed these peaks for a variety of reasons which we will show you. But that is, to us, is a great trade, and we put it on Friday in quite some size. Short of volatility, front month, short of ES. Looking to make at least 10 or 20 basis points. Why do we think S&Ps are going to have a very tough time going much higher? Well, this is the Nasdaq, and as you can see, it's just not leading anymore. We told you a few weeks back that the first signs are there that the technology sector, which is the largest sector in the S&Ps, is beginning to slow down. Well, it certainly is slowing down. We are seeing no impulsion from these moves. This is all corrective. To us, that is an indication that the upside is limited. We're not saying we're going to have huge downside, but what we're saying is that the market is going to be slow to gain, and therefore volatility in the front end is the curve in volatility is going to go steep, and that's why we are very happy to be short of the front end, long of the back end, or short of the front end and short of contracts against it. To us, NQ is telling you all you need to know at the moment. It is just it's just a mess. We have lots of support at 7,430, but we have just no oxygen up here. NQ is just not managing to lead anymore. The other big sector is XLF within the S&P 500. Well, as you can see, it's just not leading, which leaves all the heavy lifting in the S&Ps to XLV, the pharmaceuticals, which are doing very well, and other sectors which are just too small to really give it a big push either way. And therefore, while XLK and XLF are so anemic, we are very, very happy to say that the upside in the S&Ps is very limited to maximum of 1% for next week. And that gives us very great confidence to short the front end of volatility against the back end, or against contracts, which we prefer. Another chart which gives us great confidence that the upside is very limited at the moment in the States is actually the transports. As you can see, they're hugging the top of the Bollinger Bands. There is very little upside here. Basically, it's an ideal environment for the next 2 or 3 days to be short of something which converges down to the VIX, and short of contracts against it, which we all know will not be significantly higher. You're hedged every which way, and you should make quite good money out of it. And we have the trade on in quite some size. Poor Europe just cannot get out of its own way. It's bouncing off these levels, but it's done absolutely nothing to redress the very bad technical position that the stocks are in. If we spend another couple of weeks consolidating below 3,400, we are going to have enough momentum to the downside to go and test some very, very important levels around the 3,100 area, and that will be a very interesting level to buy. Conversely, that is in the DAX, that is the level that we mentioned to you so many times, and that's the 11,400 level. That is what we're looking for still. We're still looking for a test of 11,400. It might take 2 or 3 weeks, but we just can't see Europe getting out of its own way. And all this, funnily enough, leaves the dollar in absolutely no man's land. You will remember all the levels that we have given you. Those are 95.07 where it is at the moment, 96.50, 93.63. 93.63 to us is going to be the very important level where you buy straddles, because the market either explodes higher or absolutely collapses. We don't know which. 96.50. If we see 93.63, we will definitely be doing lots of straddles, and then if it breaks 96.50 after we're long on straddles, we're gonna double up. So it's a nothing burger here in the dollar. It looks like for the next couple of weeks it'll trade between 95.70 and this 94.57, basically just going either side of 95.07. It's telling us nothing, which again is good for not much happening for the next few days in equities, the market remaining relatively stable, which is what we want to make money out of our short volatility front-end trade. Another incredible long-term opportunity is actually provided by the spread between volatility in the United States and volatility in Europe. The contracts for December, so December US volatility against December Europe volatility, is actually trading very close to zero, i.e. The market is saying that volatility in Europe is going to remain the same as volatility in the States. That is to us very unlikely. We think that that move is going to be huge to the upside. We're going to have a lot more volatility in Europe than we are going to have in the States. The States is supported by Trump's policies. To us, it's almost inconceivable that that spread will close at zero. It will close at some stage. It'll probably have 150 to 200 basis points in it, and we want to make money out of that. So if you can buy volatility in Europe and sell volatility in the States in December and just hold it for a month or two, we are certain you're going to see some very big gains in that spread over that period of time. I just wanted to show you very quickly this spread between the Dow Jones and the Qs, which we've mentioned so many times, and that basically it's not a risk on, risk off, it's a defensive aggressive spread. You remember when we said when it was here to get the hell out, and it's basically looking to break towards the 200-day moving average, which is yet another indicator that the market is buying defensive sectors, rotating out of the very aggressive tech sector. Not news, but we're just saying it could accelerate, and that is yet another reason to think that the market to the upside in the S&Ps is going to be very subdued. So to the biases for next week. Here we are, watch 5 years now, we said, and now we are short. We are short futures and long 3-month 113 puts. We sell 1 week puts at 112 against it just to collect some premium because we don't think the move is going to be that quick. So that's what we are doing. We are long of 113 puts in the 5-year and selling 112 puts against it in the 1 weeks. We are short now bunds and bobbles. We're looking for a 10 basis points move. The SPX what we're saying now, 29, 20, 30 is the top. Uh, yes, I know that this is new highs and people should buy. We don't think so. We think that the top is very, very close. If we look at something, I'll show you the the forward Blue Angels. You will see that we have the 17 times Blue Angel very close. The market respects it every time it goes up there. It trades there for weeks. That's not going to move very far in the next few weeks, and therefore we think the upside is very, very limited. So 29, 20, 30 for next week is definitely the top. The pivot is still a close above or below 28.95. And as I've shown you in those weekly charts of the ES, God help it if it goes down below 28.70. It's going to go into a weekly distribution, which basically is going to be 28.70 down to 2800. And we keep on saying NQ is looking increasingly vulnerable, but there is no confirmation of it. What we are saying, just like we said in XLF, is beginning to be dead money. XLF and NQ, i.e. XLK, are beginning to be dead money. You might find much better places to invest than XLK and XLF for the next few weeks. We told you about our two-day trade, 2.5, short VXU18, short ES. We think the ES part is going to lose very little, and this part should make about 100 basis points. So we're looking for at least 20-30 basis points of pickup there. Nothing going on in the dollar. We've given you the levels. They're still there. Nothing changes. The only change here is that in Nikkei we are now long of call spreads and buying call spreads on any dip. So basically we're buying 23,000 to 24,500 1x3s in the 3 months. We think the market goes up to 24,500 at some stage this year. Thank you very much indeed, and tweet you on Monday.